TSMC just posted an absolutely record-breaking quarter, giving us living, breathing proof that the underlying AI demand is booming right now. The physical build-out of this infrastructure is real, and the numbers are spectacular.
And yet, despite that incredible fundamental confirmation, the semiconductor sector just completely crashed anyway. We saw a brutal sell-off across almost the entire chip landscape, leaving a lot of investors totally bewildered by the price action.
Which brings us to the fascinating paradox we are unpacking today. Being right about the demand thesis does not automatically guarantee a rising stock. Sometimes, the market punishes the cost of being right. Let's get into exactly what happened today.
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let's start by looking at the broader numbers, because the context here is everything. The Dow was down 0.2% to about 52,553. The S&P 500 fell 0.51% to about 7,534. The Nasdaq dropped 1.47% to about 25,882. And the Russell 2000 was down just 0.06%. Meanwhile, the VIX popped up about 6.8% to 16.73.
On the surface, that looks like a standard tech-led down day. But here's the critical tell for the session. 9 of the 11 S&P sectors actually closed green today.
Exactly. When you have 9 out of 11 sectors rising, that means we were absolutely not looking at a broad market panic. The sky was not falling across the board.
Far from it. It was a highly concentrated liquidation in one specific, crowded area. Money was actively moving around to find a new home within the stock market. It was not running away from the market entirely to hide in cash.
We can see that dynamic playing out perfectly in the defensive rotation today. Consumer staples were up 2.8%, healthcare rose 2.22%, and real estate climbed 2.02%. All of them were rising beautifully while tech suffered.
Right, and on the flip side, technology, specifically the XLK ETF, fell 2.24%, and the major chip ETFs got hit even harder.
So the capital just rotated to safety, yield, and steady cash flows within the broader market structure. People were selling the high beta names to buy boring, reliable dividend payers.
That is the classic hallmark of a sector rotation. Investors simply sold the high-flying winners that had gotten a bit too hot and parked those profits in defensive stability. The market mechanics were actually functioning very logically, even if it felt painful for tech investors.
Let's get into the earnings print that started it all today. TSMC had an incredible run. Revenue was about $40.2 billion, which is up a massive 36% year over year. Gross margin came in at 67.7%, and operating margin hit a stellar 60.3%.
It was a record profit, up roughly 77% year over year. But here's the most important part. They raised their 2026 CapEx guidance to $60 to $64 billion, while lifting their total U.S. commitment to $265 billion.
To put that $265 billion U.S. commitment into perspective, Theo, that is not just building a factory. That is essentially planting an entire new industrial city. It is generational capital expenditure.
Exactly. When a company with TSMC's incredible visibility into the supply chain commits to that kind of spend, they aren't guessing. They have locked in orders from the biggest tech companies on Earth, spanning years into the future. That is the physical manifestation of AI demand.
And they also guided full-year revenue growth to slightly above 40%. The demand signal could not be flashing a brighter, more vibrant shade of green.
This is unambiguous. The AI build-out is not just being confirmed, it is visibly accelerating. The physical infrastructure demand is massive, undeniable, and currently running at full tilt.
So, with all that incredibly bullish news, why did the stock fall? It really comes down to the Q3 gross margin guide. They guided Q3 gross margin to 65 to 67%, which is a step down, and that spooked people.
But the nuance here is so important. That dip is simply margin dilution from ramping the new 2nm node and building those expensive overseas fabs. It is just a 2 to 3 point early drag. It has absolutely nothing to do with falling customer demand.
I think people get really tripped up on that margin percentage dropping. Can you unpack the math there? How do they make more money while the margin percent goes down?
Think of it like owning a highly profitable bakery. You usually sell 1,000 artisan cakes at a 70% margin, but suddenly you get a massive corporate order for 10,000 cakes. To fulfill it, you have to buy new ovens and hire extra staff, which brings your overall margin down to 65%. Your margin rate dropped, but your absolute cash profit is astronomically higher because you sold 10 times the volume.
That is a brilliant analogy, and the math for TSMC proves it. Even with a lower margin percent, TSMC's absolute gross profit still rises about 9.6% quarter over quarter, simply because the revenue base is growing so much faster.
Exactly. It is a necessary investment cost to secure future dominance. But the market gave us a classic sell the news reaction to the margin percentage today, completely ignoring that the absolute profit growth is what actually pays the dividends and funds the future.
There is also a major myth circulating today that we need to bust. People naturally assumed TSMC dragged the entire chip complex down with it because it is such a heavyweight.
It's a great lesson in how ETF mechanics actually work. People see TSMC down. They see the SMH semiconductor ETF down 3.7%, and they automatically link the two events as cause and effect.
Let's run the actual math on that. TSMC is only about 9.5% of the SMH ETF. Its roughly 3% dip today contributed only about 0.30 of a percentage point to the SMH's total 3.7% drop.
Right. The math simply does not support that panic narrative. If a stock is 9.5% of a basket and it drops roughly 3%, it only pulls the basket down by about 1/3 of 1%. It is simple multiplication.
Translation. The other 3.4 points of that drop came from somewhere else entirely.
Yes, when the ETF falls 3.7%, you have to look under the hood. Those other 3.4 points came from a massive tide pulling down almost everything else in that basket. A broad, crowded position unwind. TSMC was just the backdrop.
So where did the real selling hit? Storage and memory got completely crushed today. SanDisk was down about 12%, Western Digital dropped about 9%, Seagate fell about 10%, and Micron was down about 6%.
Second-tier chips took a massive beating too. Marvell was down about 9%, while ARM, Intel, and AMD each dropped roughly 6%.
And the optics sector did not escape the pain either. Coherent, Lumentum, and Applied Optoelectronics were all down between 6 to 9%.
These were the universally crowded trades. Everyone was hiding in these names because they felt like the safest picks for the AI boom. And as we often see, crowded trades always unwind the hardest when the momentum finally breaks.
Which brings us to the big theme today. TSMC confirmed the build, but the market violently repriced the funding burden of that build. It is a fascinating dynamic where we are seeing the market fully digest the reality of what building this AI infrastructure actually costs.
That is the core dynamic. More capex means they're buying massive, incredibly expensive machines from companies like ASML. Those machines depreciate, which hits the accounting profits, and they consume massive free cash flow today to build capacity for tomorrow.
So the fundamentals actually improved today, while the trade fell apart. Being right about the destination clearly doesn't mean the ride is smooth.
Not at all. When you have a stock that every fund manager already owns, any reminder of those near-term costs can trigger a rush to the exits. And we always have to add the humility line here. This is a likelihood game. No one predicts the future. Just one read of the setup today.
It's such a vital point. The demand is there, but the cost of supplying the AI revolution is getting priced in, and it's landing on an extremely crowded ownership base.
Which is exactly why you see these violent shakeouts even on days when the fundamental news is objectively spectacular. The market is forward-looking, and right now, it is looking at the bill.
We saw the ultimate consequence of this digestion process in Korea today. Let's use them as a cautionary case. The Bank of Korea raised rates 25 basis points to 2.75%.
Which was their first hike in about 3.5 years. And crucially, it was completely in line with what economists expected. It was not a shock to the macroeconomic system.
Yet the Kospi index plunged 6.37% and triggered its 8th circuit breaker. Regulators had to step in and tighten margin and deposit rules on leveraged products.
The forced deleveraging just keeps feeding the selling over there. It is a harsh human lesson. Leverage can force you out of a position long before a correct thesis has time to actually prove itself.
Korean retail investors were entirely right that memory demand is real, but many still got margin called to zero anyway. It is heartbreaking to be completely right about the trend and still lose your capital.
So as a general principle, not personal advice, but something to keep in mind. Diversify for real. Avoid borrowed money where you can. Size your positions so you can survive a 20 to 30% air pocket, and always keep some dry powder. Being right is simply not enough if you cannot survive to see it.
Let's take a moment to reassure on the memory thesis itself, because that distinction is so critical right now. The commodity memory fear, like China's CXMT ramping up supply, is a very real threat for conventional DRAM pricing.
But it is absolutely not proof that AI memory demand broke. How should people visualize the difference between conventional DRAM and high-bandwidth memory?
That is the question of the hour. They are fundamentally different products serving fundamentally different needs.
Think of conventional DRAM, like the standard tires on a family sedan. There are a lot of factories globally that can make them, and when a new factory like CXMT ramps up, the market gets flooded and prices drop. But HBM is like the custom racing slicks required for a Formula One car. They are insanely difficult to manufacture. The yield rates are tricky, and you absolutely need them for Nvidia's GPUs to function.
Right. CXMT is a conventional DRAM pricing threat, not a near-term HBM leader. Furthermore, ASML's and TSMC's CapEx guides both confirm that the equipment and foundry cycle is entirely intact.
Exactly. They are entirely separate markets with completely different supply and demand physics. Commodity memory and the AI bottleneck are two different things, and it is vital not to conflate them when the sector sells off.
Moving over to the software side of the ledger, Alphabet fell about 4.4% today.
This drop came after reports surfaced that its flagship Gemini 3.5 Pro model was delayed. It is reportedly months behind schedule after falling short of Google's own internal coding capability goals.
But it is incredibly important to frame this properly. This is company-specific execution stumbling, not a broad software collapse across the industry.
Precisely. Microsoft held the $400 line today, and the software group overall was not wiped out by this news. This is one company's model timeline issue, not the end of the software narrative.
Now for the real counterpoint of the day, and it's a big one. While the crowded merchant silicon chip trade crashed, Apple quietly climbed 1.76% to a fresh record high around $333.
Why is Apple different? Because its AI story is edge AI, on-device intelligence, combined with vertical integration and services. It is fundamentally not the crowded HBM and merchant silicon cycle that everyone else piled into.
Let's pause on that difference, because it is the key to Apple's resilience today. When we say merchant silicon versus vertical integration, what does that actually mean for the stock and the underlying business?
Merchant silicon refers to companies selling chips to everyone else. That is the crowded trade where everyone is fighting for capacity, allocation, and pricing power. Apple isn't doing that. They design their own silicon for their own devices, to run their own localized AI models for a closed ecosystem of 1 billion plus users. They aren't trying to sell server chips. They're trying to sell an upgraded iPhone. It's a totally different business model.
And its edge AI story just got materially closer to reality. China cleared Apple Intelligence for its market, with Alibaba's Qwen powering the localized experience. That removes a massive obstacle in a highly critical iPhone market.
On top of that, Siri's AI upgrade moved from promise into active developer testing, with the broad rollout targeted for the fall. Apple already has a roughly 3 billion parameter on-device model working, with a private cloud compute fallback for bigger tasks. And the next iPhone, the 18 on TSMC's 2nm process, is expected to move to a 12GB baseline of DRAM, 16 on the Pro, up from 8. That quietly but significantly grows memory content per phone.
There are also reports that Apple is hunting to acquire AI chip companies to build its own AI server processors and reduce its dependence on Nvidia. But we do need to offer a thoughtful caveat here. Edge AI is closer to deployment, but it is not yet a proven killer app. Real user engagement and monetization are still unproven, and after a big run, the stock is extended, not a fresh, easy entry.
That is a great point. And this is a likelihood game. No one predicts the future, just one read of the setup today. But the core point is that Edge AI is additive to Cloud AI. It still feeds TSMC, ARM, memory content, and the equipment makers. It is a profound reminder that within chips and AI, not all exposures are the same. Some crashed today, while one made a record high.
Looking at the macro picture today, gold fell about 1.6%. The dollar index rose about 0.2%, and the 10-year Treasury yield rose to about 4.57%.
The driver here was exceptionally strong U.S. data. Weekly jobless claims came in at 208,000, which was significantly better than the 216,000 expected.
And the Philadelphia Fed Manufacturing Index rocketed to 41.4 versus about 13 expected. That is a massive upside surprise. For those who might not track the bond market every day, why does a strong manufacturing number in Philadelphia push the price of gold down? What is the mechanical link there?
It's a great question. When economic data comes in red hot, like that huge upside surprise in the Philly Fed Index, the bond market assumes inflation might stay sticky, meaning the Federal Reserve will keep interest rates higher for longer. So, the yield on the 10-year Treasury goes up.
Ah, I see. And because gold pays no yield, it just sits in a vault. Higher yields on safe government bonds make gold less attractive by comparison.
Exactly. So its price falls. And it is important to note this was a data-driven move, not a peace broke out headline, because geopolitics definitely stayed very tense today.
We also had some wild late-day action to cover. Into the close, a systematic tech sell program pushed Microsoft down to exactly $400 while yields and oil sat perfectly flat.
Just an algorithmic program executing its orders. Then a huge closing auction produced a partial rebound, and Microsoft managed to finish at 401.10, up 1.38%.
And looking after the bell, Netflix beat narrowly on earnings, posting an adjusted 80 cent versus 79 expected. But revenue of $12.56 billion missed slightly, and they narrowed their full-year revenue range, sending shares down about 8% after hours.
We also saw Intuitive Surgical beat nicely. Revenue was $2.89 billion, up 19%, adjusted EPS at 2.80, and procedures up 16%. Yet it still fell about 9% after hours on growth deceleration and a rich valuation. The theme holds. Even good prints got sold when expectations were already sky high.
Let's step back and pull the narrative thread together. So when we piece this all together, the theme of the day really isn't about AI failing. It's about the plumbing of the market itself.
Exactly. It is entirely about positioning. When everyone is on the same side of the boat, even a slight shift in the wind, like a minor gross margin dip from TSMC or a rate hike in Korea, can cause a massive scramble.
But the demand side of the AI thesis is fully intact and even strengthening. Both TSMC and ASML confirmed it. The weakness was about the funding cost repricing and that Korean leverage situation. It was not a break in the thesis itself. No kill criterion fired today.
The fundamental demand thesis remains incredibly robust. This looks far more like a crowded trade cleanout than the start of an AI bust.
I agree entirely. It is painful, but it is mechanical.
Though again, we must remember, this is a likelihood game. No one predicts the future. Just one read of the setup today. Tomorrow's tape could easily refine this picture further.
Looking ahead, tomorrow is Friday, which means monthly options expiration, and that can really amplify market moves as dealers hedge their books. We also get housing starts, industrial production, and the University of Michigan consumer sentiment reading.
Then the earnings gauntlet really begins. Alphabet, ServiceNow, GE Vernova, IBM, and Tesla all report on the 22nd.
Followed by Freeport and Intel on the 23rd, and Microsoft and Meta on the 29th.
That is when we will truly find out if these software and AI capex debates get resolved with hard data.
To bring it all home, TSMC proved the thesis, and the stock still fell anyway. The lesson of the day is the heavy cost, the crowding, and the dangerous leverage of being right.
The physical AI build is intact. The pain was strictly about positioning, not demand. You have to survive to be right. So please, do your own research.
That's the wrap for today. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.